Good morning, everyone. Thank you, Sahaj, for that introduction. I thought what we do today, there's a wealth of experience here, both in Indian markets and for some of us here in global markets. And what we try to do for the first 10, 15 minutes is go top down, try to understand what the macro means to general partners and actually one limited partner here from how they're thinking about India. And then turn it around and go bottoms up and see, as Sahad, you were saying, if the macro is truly creating deal flow, exits, full cycle liquidity, turning it into a better PE environment. You said, it feels like 05 and 06. That's a mixed blessing because, those were crazy times as well. So I thought we'd do that. What I'd like to do is, first turn it over. We'll start with Srinath, you on the corner there. And is this a new India? Is this really finally turning around after, as I was saying earlier in the meeting room, we've gone, at least in public markets, from a Manmohan multiple to a Modi multiple on most things. That's the one clear evidence of it being a new India. But on the ground reality, Q3 earnings came out, not that great for most public companies. Are you truly seeing a difference?
So I think the Modi phenomenon has definitely led the markets a little ahead. There's a lot of optimism that things are about to change. But on the ground, to answer this question, when we look at our portfolio companies, there is growth, but it's a very, let's say, controlled or conservative outlook of things to change. I can't say with all confidence that it's gun blazing and the markets have taken off, companies are selling their products and services at a very great pace compared to the past. Things have improved. People are being a little cautious about committing capital, but we are definitely seeing all boards talking about committing capital over the next 6 months, 9 months, 1 year, in anticipation that 16, 17 things will be quite robust and they need to be ready to catch the opportunity. Every company, there is optimism, but it's a cautious optimism, I would say.
Rahul, I know you're a long-term student of the Indian economy, so I'm really looking forward to hearing what you have to say from just, is the 2015 macro reminiscent of any time in the past in India? Is there another country you'd compare it to? This kind of $50 oil slash CPI coming down to 4 or 5%, current account deficit at, maybe, so I read somewhere yesterday it might be a current account surplus next year. What does that do to your investing style and how do you think about India differently?
So if I think about the various factors driving India at this moment, one thing that I'd first like to start with a slightly cautious note and then bring in some historical context, but the economy which was inherited by this government was in a comprehensive mess. The previous government had essentially not focused on any form of sustainable growth, but essentially printed money and given handouts to various stakeholders in the society, which led to a consumption boom across several sectors, which showed you some growth numbers. Even though they were declining, they showed some growth numbers, but also showed inflation of 10% a year for over 6 years. It's the longest single spate of inflation in that period of time in the history of India, let alone probably in lots of countries. So to start fixing this and fix structural things, capital allocation towards productive sectors which generate income and then therefore sustain consumption, the balance of shifting from unsustainable level of GDP to a sustainable level of GDP and accelerating growth is a longer process than either our capital markets or most of our press seem to imagine. It's not something which happens overnight. I have in my career at some point turned around a company with 3,000 people. I had to run it myself. It took me 18 months and I was also working 20 hours a day. To turn around a country of India size, if they do it in this, in 3 years, I think it'll be an incredible job. So I think that, for us to look every quarter and say that have the numbers changed and gotten better, I think what's more important to see is the way those numbers are coming, is that a more sustainable way? I think that's the way I would like to look at India, and I'm extremely encouraged by what I see, because we are getting onto a growth trajectory as against something which was unsustainable. And if you look at any kind of historical context, again, people miss this, but The world from 300 BC to 1820, per capita income around the world, other than for 3 aberrations, stayed almost identical around the world, right? Till 1820, which means that other than for the Hanseatic League, which had its own development engine, the British Empire, and in prior history, it was the states of Naples, Venice, city-states, which had extraordinarily higher income than the rest of the world. But other than for that, your population determined your per capita income, and India accounted for 25% of world GDP in 1820. There was the inflection point happened after that. So if you look at the countries which have become rich and powerful, it's less than a 200-year phenomenon. And most countries have gone from that base sustainable level of GDP to a rich country in a period of 30 years. Take Japan. In 1870, it was an agrarian economy, very poor, doing nothing. By 1900, it was one of the richest countries in the world on a per capita basis. Take Singapore, take South Korea, take Taiwan, take China. You'll find the same model being repeated time and time again. You start getting the economics right, it takes roughly a 30-year period. There's also studies by a gentleman called Agnes Madison, he was a British economist, who says that a country who is not the richest country in the world, but significantly poorer, the further he is away from the richest countries in the world, by simply diffusion of technology tends to grow fast, and there's tons and tons of studies around it. Right? India, we are very fortunate. We have corporate sector which is far more sophisticated than our stage of the economy suggests or allows or usually is found anywhere in the world. And it's quite dominant and it's very entrepreneurial. I don't know how many of you know this. I was just looking at a study since 1979. In US dollar terms, which is the best performing stock market in the world since 1979? How many of you would guess the answer is India? It is India. Since 1979, we are the best performing stock market anywhere in the world in US dollars. And guess what? That happened with an 89% cumulative depreciation in the value of the rupee. So we've got, and you throw in low oil prices in this mix, low commodity prices, you talk about low interest rates because there's so much debt around the world that no one can raise interest rates. At a time when we are the most underinvested country in the world, where most supply chains everywhere in the world have been overinvested in, so you'll get goods and products at marginal cost of capital. I think that it's not of our making, but I think that we are absolutely in the right place at the right time.
Thank you, Rahul. On that very positive note, Vish, the question for you is, you probably have, a broader view, not just India, but you probably sit inside an organization that sees things across emerging markets. How are you guys looking at, what Sahad was saying, China versus India, Brazil versus India, developed market versus India? Of course, you have the, kind of a currency devaluation thesis that you have to have around the Indian currency. But if what Rahul is suggesting is true, that, and what Srinath is suggesting is true, that we're at the beginning of a serious capital formation cycle, and we have a lot of low-hanging fruit. How are you guys thinking at your shop?
Sure. So I guess my view is that India is, as the other panelists have said, we are in a very fortunate position today. And not necessarily because things have dramatically turned around, but because the other BRIC countries have scored a self-goal, pretty much. So if you look at Brazil, there is, the overriding thesis around some of the BRIC countries can be encapsulated in one word, essentially commodities, right? So China was a massive consumer of commodities. The slowdown has caused the commodity prices to come off. Brazil and Russia are completely dependent in terms of their economies on commodity prices. So the reduction of prices there of commodities, oil, soya bean, iron ore, etc., have had a major impact. And India, benefits because of being a net importer of commodities. So commodities have driven a lot of the reduction in GDP as well as the performance of Brazil and Russia, and the slowdown in China. So in that sense, India is benefiting a lot from this commodity price reduction. Specifically, if you look at Brazil, I mean, the corruption is a big issue there. The government doesn't have the credibility to really to grow. Currency is an issue. Soybean, iron ore, oil prices have had a major impact. Russia, we have some investments there. You know, one of the largest retailers there is a company called Lenta, which we invested in, and it's listed on the London Stock Exchange. The stock fell 40% in one day. You know, market cap went down from, you know, by almost $1 billion in one day because the ruble depreciated. So, you know, and on back of performance, which is 25% same-store sales growth, right? So it's a phenomenally growing company, but keep in mind, inflation is at 17%. So it's a, you know, very troubled economy at this point. Not a lot of investing options there. China, the thesis is all around the consumer. I think, you know, it was a highly export-driven market, growing very rapidly, and the thesis was the consumer spending will eventually pick up, just the way consumer spending is a major part of the economy in India and the US. But that hasn't happened. Real estate prices have kind of dragged the sentiment down, and the consumer really hasn't really picked up and shown legs. So China's you know, slowing down, as Sahat said. Growth rates of China are now 24-year lows since 1990. So it's and it's not expected to turn around. So in many ways, our being ahead of the BRIC countries is not a function of necessarily India shining again, not yet at least, but really that the other countries have scored self-goals.
Okay, thanks Vish, thanks, very interesting perspective. Paddy, you're in the unique spot of being not only a capital allocator, but you know, sitting and having a vantage point into one of India's most respected groups as well. You know, are you guys, I mean, from both your, you know, kind of, you know, in both places, are you A, starting to see the hints of what Srinath was saying, you know, capital being invested, you know, business groups getting more confident, and B, do you see kind of, you know, from a capital allocator's viewpoint, do you see kind of yourself getting more confident about investing in sectors where perhaps all of us around this table have been hesitant to go in, you know, in the last few years?
Sure. So on the macro aspects first, I think clearly the mood is getting more confident. It will take time, as Rahul mentioned, for things to reverse, and it's a gradual process. I think we're seeing a lot of corporates, including within the group, dusting their business plans and getting them ready for investments. I think there is a strong government focus on the Make in India and Innovate in India initiative. So some of that should, you know, see more, you know, an expansion of the investable universe from a private equity perspective, as sectors like manufacturing and industrials open up. That's very important, because I think one of the challenges in 2007 was that a lot of capital was going in and into the investable universe, which was relatively not of a similar scale. So the demand-supply balance was skewed. I think if the investable universe widens, then, you know, even if more capital comes into India, which should, you know, you probably have reasonably priced deals happening, which is critical. I think translating to macro to private equity, I think the main challenge has been in the past years of GPs perhaps investing at a price and underwriting a growth rate which didn't come through. So macro doesn't necessarily translate into better returns. What's critical is that we underwrite sensibly, such that the growth rates are what we build into our cases, or better than that. So I think the price discipline is going to be a critical thing. And in Indian private equity has great potential. The performance has not matched up to the potential. So this is the time where we really need to make sure the performance matches up to the potential. And we invest sensibly. So also we are in an environment where 10-year government bond yields across the world in the developed market are close to 0%. Yeah. So honestly, even if you can deliver a low teens dollar return to investors, I think it's remarkable in that context. So, but it's important there are no blowouts along the way, you know, that we do it in a sort of stable, predictable way, as stable and predictable as equity as an asset class can be. So we've been actually making some contrarian bets. So we'd invested in the industrial space prior to the elections, and obviously some of that is looking good in the current context. And the other point of view I have is it's always sort of dangerous chasing momentum. In the public markets, you can do that because you can exit very quickly. In private equity markets, you need to look at more sustainable stories and at the right price. So that's how I would translate the macro into our private equity strategy.
Thank you, Patty. On the other, you've got the distinction of being the one guy here who allocates capital to funds, allocates capital directly, allocates capital across Asia. Has your view on India changed, and how so? Obviously, both as a direct investor, but also as a fund investor. As you look at Indian private equity, Indian venture, how are you thinking about it differently post the elections and in today's macro environment?
So in today's environment, there's a few things, right? There are different kind of investors who invest in private equity as an asset class itself, or private investments. There is typical fund investors or PE funds who are trying to look for a 4 to 5 year cycle. And there are sovereign wealth funds and pensions and all who can look for a much longer term cycle. Interestingly, what we see at the current point of time in India, given what the government is doing, like what Rahul said, a lot of the reforms are not for making a dramatic change in 2 or 3 quarters. These are reforms which are supposed to make dramatic change in the way the country performs in 3-year, 5-year point of time. But if you're a private investor, you will still have to bake in that price when you go in, even now. So longer term investors like a pension who want to allocate into India for 15 years, it is a good time to get into these companies if you get your macro themes right. So Patty, I agree with you on things like manufacturing and all. Now you assume that the government gets it right in terms of the policies and getting some of these things working. Investing behind Indian entrepreneurship is another big thing. So it's not just e-commerce when I say entrepreneurship. There is actually a bunch of areas in which new entrepreneurs are going to come out when a country takes off. But it's a longer term strategy. There is another reason why I'm more saying it is longer term than short term growth capital PE, because PE normally makes money either on leverage, which is not available on growth capital. You make money on valuations, which unfortunately in entire emerging market where we see India is actually the highest place on average valuations which you pay. I know that a lot of you guys out there on the table may have deals in which you got into great valuations. I'm talking about across the board valuations are higher. So if you want to, as an institutional investors like us, we look for 20% returns still from alternatives as an asset class. That's not changed. Then you need to make 25 on a gross basis, and if you think for currency, another 2-3 percentage point, 28%, all that have to come from bottom line growth. There is no other lever to pull. And doing that in the current scenario, 3 to 4 years, and building an entire portfolio which grows, say 28% bottom line, it is still a very tall ask in India. So that's why growth capital, private equity, still not an area where we are putting a lot of money to work on.
Okay. Well, 28% is the hurdle. He said it. So, since we need reforms to get there, I'll start with you again. And kind of now be very specific. I think we've had our, top-down, sort of viewpoint. What's the one reform that either already has been, kind of ordinanced, given that, they can't get anything through the Rajya Sabha, or there, you think is going to happen in the next, call it 3-4 quarters, this budget, post the budget, that you'd really be looking for to say this is a game changer. This one reform would change, in your mind, the trajectory. And as we go from 5.7% GDP growth post pre-revision to a 7-8% number that everybody wants to go to.
So I'll try to answer that a little differently. I think first from the private equity industry perspective, I've been on a few of the PVC representations to the government for this budget. And the first thing which I think everybody's paralyzed is the tax pass-through issue for the fund. So literally almost even the Indian LPs are waiting to see if the clarification comes out in the budget vis-a-vis how tax pass-through for the PE fund industry will have clarity, because at the moment it seems that if we have to look at what Anand was saying, return would be quite impacted negatively if the tax clarity doesn't come for the industry, and that itself will put a little bit of brakes for fundraising for the industry. That's one, I would say, is the main thing which we would like to see in this current budget, which will have a big impact on our industry. And the sentiment, the whole tax issue around so many things, and I can go on listing various issues from small to big. If a PE guy invests in an unlisted company, he has a different tax incidence when he exits versus a public market guy when he does a short-term investment into an unlisted company. There are so many disparities which create a little bit of hesitation in the mind of investors. Those things need to get cleared up in the macro perspective for the floodgates to really open. Then I think people will start chasing business rather than chase regulatory aspects or deal with regulatory aspects in the country.
So clear tax structure, very good point. Rahul?
Since I don't believe we're in a position to give sops to anybody, I think I'd go with the structural one. I'd really like to see the accounting firms and the accounting industry be regulated and held for consequences of fraud or misrepresentation. Not carelessness, but whenever an accounting firm knows that what they're writing is wrong or signing off on something which is misleading or wrong, just like it is in any other part of the world, accounting firms in India should be held responsible for it. I think it will change the entire ecosystem considerably.
So now that all of Rahul's company's auditors have resigned, let's move on to Vish. And thank you, Rahul. That's one thing very specific. I think Rahul's been very specific. So Srinath, one thing very specific that you'd like to see.
So specifically, I would love to see bankruptcy laws in India change. India is one of those unique countries where if an entrepreneur takes debt and takes a risk, builds a project, and it doesn't work out, the only people who lose out are actually the lenders, which is a bizarre situation where you go through the CDR process and essentially the write-down comes after a very protracted set of negotiations, and the only person who takes the hit is not the promoter but the banks. So you need to have a regime where there is a, similar to the US, a Chapter 7, Chapter 11 type of process where there is accountability for equity, and there is accountability and there is speediness in the process of resolving some of these situations. Any growth market, there will always be situations where entrepreneurs take a risk and things don't work out. But unless and until there is accountability for the equity holder, the debt holders are not going to be emboldened enough to do the right, follow the right behavior. So it's, and there are a lot of companies that go through this process, and unless and until that piece of it is resolved, a lot of the malaise in the PSU banks, the reason why they're all trading at called 1x book or lower, while private sector banks are now trading at 3x book, while 60% of the total loan book of the country is actually the PSU banks. So you can't have an economy with such a large percentage of the loan book sitting in a government-controlled sector with not enough reform around the bankruptcy-related laws.
Well, you and Mr. Rajan are on the same page on this. He's been very, very vociferous on cram down and building a Chapter 11 code, and I think you're right. I think it'll open up the economy. Paddy?
I would say tax simplification and stability. No SOPs. Simplification and stability, and incentivize those who are tax compliant rather than make them pay through the nose. I know all of us would have examples, and I'm not talking about private equity now, but even sectors we invest into. For instance, we invested in a DTH platform, a satellite pay TV platform. You have people outside the tax net who don't pay tax, but satellite pay TV, for instance, pays indirect taxes of close to 30%. Now, what's the logic for that? You want to improve compliance, you want to bring more people into tax net. GST obviously is a big issue within tax, and I think if the government manages that, I think that'll be a big positive. But overall, just simplify tax and make it stable and predictable.
Okay. Anand?
I think one of the biggest things which I would like to see changing is the labor reforms.
Okay.
Literally bringing it down to the standards of where any other country which has done very well in terms of manufacturing have followed, where you have an opportunity to hire and fire people if the situation demands so, and without have to go through 200 loops. That's very important.
Okay. Well, now let me go the other way. Anand, you can keep your mic in your hand. As and then we'll kind of go through this quickly as well. I think like we did this one. Are there sectors? I think what Paddy was saying earlier. Look, macro doesn't necessarily. And you were saying the same thing. Macro doesn't necessarily translate into private equity returns. We as investors, we can't wait. We have LPs to answer to. We can't really wait to see. We have a finite timeline, and we get paid to kind of make money no matter what the macro really does. So as you look through that today, and you look through your vision, are there certain sectors as a direct investor, that you look at today and say, this is kind of this will make sense over the next 3 to 5 years, no matter what really happens with the macro here.
So I'd put some context to this because one of the markets which have done very well for private equity, obviously macro helped, but it is China. So it is not just that the winds took Chinese private equity along with it. Like many people think so, it is actually not. What many Chinese private equity funds have done very well is they have figured out sectors in macro and they just invested in them. And in China, it's more about backing what the government want to back. Initially, it was manufacturing, so a lot of money was made there, like friends in TPG here, for example. Then currently, it is actually healthcare is a big theme because the government is pushing it. In between, there was environment technologies and also e-commerce and all the technology investments in China when that wave took off. So they had been investing and catching the waves, and those who caught the waves made a lot of money. Now, if I really look at similar as a wave in India, it's actually the entire technology and entire entrepreneurial ecosystem. You need to actually invest behind that because, as we all discuss now, the economy turning around and our normal every business going and doing the same thing is going to take a long time. So people need to focus on what is going to give us that short-term returns if you are a fund which is trying to exit in 4 or 5 years. And I'll give you a very interesting anecdote why I say this. 2003, China had $4 billion of technology market cap. In a lot of metrics, it was actually the same way where India is currently standing. And in next 7 years, technology market cap in China went up 25x. Anyone who invested in literally the index made 25x. Probably, I know there'll be a lot of naysayers in this room probably against this, but I just saw a recent Morgan Stanley prediction. Their prediction is like India is currently at $4 billion, by the way, in tech market cap, and it could be 34x in next 7 years. That could be the best place to look at.
Okay, well, technology and the entrepreneurial ecosystem. Certainly, we see, the Economic Times every morning, certainly agrees with you. I think, Paddy. Sectors that you love today, that you're looking at very favorably?
I think as Anand said, if you catch a wave early in a sector, then you tend to benefit from it. But in today's context, with public market valuations where they are, I don't think we'd be driven too much by top-down sector calls, but we will look at more bottom-up value. But in the past, as I mentioned previously, it's worked where, we felt like, for instance, in industrials at one point of time before the elections, it was, if you find a quality company, it's likely to get a good return. But in today's public market benchmarks, we'll really do bottom-up work to decide on investments.
And in bottoms up, you say sort of company specific, not you're saying, we're at this point, it's more of a stock pickers market, kind of go pick companies.
So in our case, we try and play to our strength as a flagship Tata private equity fund. We look at investment opportunities where we feel we are advantaged, where we can bring specific value or the counterparty can perceive we're bringing value. So we're playing to that rather than specific sectors. So it could be companies across sectors, really.
Vish?
Yeah, so I agree with Paddy. I think if you look at the last 10 years of private equity in India, the people who got rewarded really were people who picked the right macros, so the right subsectors, and getting the right sector call right was rewarding. Now I think with many more funds in India, a lot of capital here, pretty much as I look across some of our peers, the sectors remain the same. It's healthcare, consumer, financial services, and tech. That's probably be 80% of what everyone chases. It's not that there is necessarily a differentiation in the type of sectors that you chase. It's all about the micro, getting the right company, the right promoter. From our fund's perspective, our philosophy is that of adding a lot of value to the portfolio. So whether it's our portfolio companies around the world, operating executives, we've now focused most of our hiring actually on hiring operating people in our teams rather than investing professionals. Promoters are now beginning to discern Fund A from Fund B based on the value add that funds are bringing. So a lot of the bulking up that a lot of funds have done, including us, is making sure that we can bring the right set of toolkits to the promoters to help them grow other than just provide capital. So the sectors I would say are those four which our firm has a lot of strengths globally. A lot of our $60 billion of capital are focused around healthcare, consumer, financial services, and tech. But to Paddy's point, it's now more about the micro rather than the macro.
Okay, that's a very good point. So Rahul, with that evolved, nuanced view on operational value add now makes a difference, and we're all going to have to find great businesses, great entrepreneurs, and then help them really build their businesses, roll up our sleeves. With that sort of context, what are you thinking in terms of where do you put your money to work?
I think the answers are pretty straightforward. You've got to operate within your sphere of competence, what you understand well yourself, and you've got to pick the sectors which are going to be able to give you long-term sustainable compounding growth, which means necessarily a decent return on capital employed, which means necessarily sectors which have lower capital intensity, and that I think it's the same in terms of themes in that perspective. But I also believe that one of the most dangerous things that one can do in today's world from a macro perspective is that to follow Anand's advice of trying to hit a 28% kind of return, that is actually a higher return than Warren Buffett has achieved during his lifetime, right? If you try and chase very high returns, you will end up making mistakes and you will end up taking risks which are completely disproportionate. So I think that it's better to look for the solidity and the predictability. When you've had virtually zero cost of capital worldwide for a period of 6 to 8 years, and you actually have negative interest rates in countries like Sweden at the moment, to chase very high returns in this with this background, this environment, I think you might as well go to the casino then in that perspective, because no asset class in the world will achieve those kinds of returns. I mean, forget India, forget Indian equity. It is not going to be China. It's not going to be any asset class anywhere in the world. You are going to have significantly lower returns. I mean, you can look at investment returns over 200 years across asset classes. When you've had periods of very low cost of capital for a sustained period, you tend to have asset price inflation. Periods which follow that always have lower returns on capital. I think the challenge on private equity or high cost asset management businesses is to justify your higher cost basis, whether it's by generating alpha or by looking at the way in which we engage in our own cost structures too, because if we don't add that value, we'll be found out.
So with that, with that cautious warning on returns to Anand, Srinath, where are you finding?
I'm quite relieved with what my panelists are saying, that we chase things bottoms up rather than macro things. Then you need to be a momentum player. For us, we've always, in this current fund, we've been a bottoms up approach. I would think that what excites me as a read, and I think in terms of, if you really look at the push at renewable energies, which is happening currently, and solar renewable energy, etc., I think it's a very interesting sector to look at. And financial services across so many years, if you see, and if you look consistently, any private equity fund which is invested in the financial services space has made money. I think that remains to be an attractive space to keep looking at and finding winners there. Defense is going to see a boom, but defense has its own challenges of lumpy orders coming to companies, so people have to be patient, plus the other issues relating to defense. I think other than these three, our approach is going to be bottoms-up approach and see which company makes profit rather than to chase a sales top line consistently.
Rahul was going to say something. Since he always agrees with everybody, I think.
Yeah, I just in fact want to make a point as far as specifically as far as alternatives in India is concerned. I would sort of this thing a note of caution for the simple reason, as long as political classes in this country go to the electorate and say that we will give you free power, or we will give you cheaper power, or we will wriggle out of our commitments to electricity companies. By the way, I don't know how many of you have seen AAP's manifesto in Delhi. And the first 5 items, there is an item which says, we will wriggle out of our contracts from power purchase and power purchase agreements. The minute you have the mindset of saying free or subsidized power to back any kind of power generating mechanism which is more expensive power, even though cleaner, is a very dangerous thing to do in a place like India. The day you hear the politicians go to people and say, you know what, cleaner power will lead to better environment, it's better for your health, please pay more for your electricity, that's when I would start investing in clean power, but not before that.
I don't think, should we have another panel about this issue?
That might take
value
long.
chain one should invest. So
Well, we're running out of time, so we're going to open it up. Thank you, everybody. We're going to, Indian companies trying to acquire, grow into other geographies, especially, I think, some of the, companies that you might have seen from other geographies.
No, I think it's a interesting opportunity. I would say it has to be done in a very methodical way. There was a huge wave of investments back in 07, 08, where Indian companies went on a buying spree for global assets. And some of them have worked out, some of them have not. The JLR Tata acquisition has worked out well for reasons probably that they didn't anticipate, which is China really liked, cars made by JLR, but some others haven't worked out, and a lot of companies took FCCBs at that time to fund these acquisitions, and it took them a long time to actually figure out that just buying at cheap multiples in other markets doesn't necessarily mean you have the competencies to run business in Europe or other parts of the world. So I have no doubt that India will produce many multinational companies emerging out of India. In fact, Amit and I, our funds have invested in a company called Sutures India, which is actually becoming a global provider of medical consumables. India is a very, very respected name now in terms of providing, even complex products like sutures, meshes, tapes, so on and so forth, and they are making acquisitions outside of India. So we really see that there's a lot of potential in specific sectors, but I would say you have to be careful, you have to make sure that the thesis is correct, you have the management capabilities to actually assimilate those acquisitions, not just buy for bulking up revenues and buying cheap EBITDA.
Very quickly, I think if any investment strategy which has done well the last 6-7 years in India was actually focused on that theme, because the Indian market demand was actually declining. I mean, we went in 2008 of 10.2% real GDP growth to 4.5 at the bottom. So if you've had to make money in India over the last so many years, it had to be a global supply chain and a global this thing. In fact, more than 80% of our portfolio today has that phenomenon. But if you look ahead, it's going to be Indian growth which is going to be the delta shift. So I would think that, the time has come when a strategy which worked brilliantly in the past, and of course, if you have businesses which have the managerial capability to develop a footprint globally, I think the pharma sector, for one, to my mind, it's, we supply 6.5% of pharma market worldwide. My own take is in 20 years, we'll be over 30% of the global pharma market. So there are those kinds of sectors which have sector themes, but there are also companies like, say, a company like Reddington, for example, which is very clearly developing its footprint all over the world. So whether it's through strong management or through sector clusters, that theme will always be there and it'll add extra. But if you look at the delta shift from here, I think it's going to be the Indian opportunity of the next 5 or 10 years.
Thanks, Rahul.
Amit,
But-
I just
but-
actually have a
Okay,
little
you
bit
have a
of
point.
thing to add there. To the technology point, for example, as I said, Anand, I completely hear you. A lot of entrepreneurs, we ourselves are helping people grow from India to Indonesia, India to China. One great area where, for example, we see a lot of opportunity. India is going to be the largest mobile-first market in the globe. In next 5 years, we'll have 600 million people who will first touch internet in mobile. Not even in China you have that number. And this is going to be the largest ever first mobile market in this world. That means some of the best mobile technologies in the world is going to come out from India. That would be probably the place where you would make the maximum money. So I hear you.
We're almost out of time, but we'll take one last question right in front here. Well, great. Thank you, everybody. Thank you so much. Thank you to the audience. Thank you to the panelists. Thank you.